Hi, this is Dan Collins, Editor-in-Chief of Modern Trader Magazine, coming to you live from the floor of CME Group for Traders Exclusive. We are in the middle of January in a more than month-long kind of slow period for the market. Everyone was talking about the Trump rally after the election. The market had a strong rally and it pretty much peaked around middle of December, a little bit earlier, December 9th, and we've been in this flat period. We got within less than a point of Dow 20,000, and it hasn't hit there yet. Will we? Well, maybe we will and maybe we won't, but to quote a former Federal Reserve Board chairman, we may be seeing some irrational exuberance. And here's why. While it seems like those, especially in the business news media, that is really, really bearish and promoting a huge move in stocks, really, they seem to fail to realize where we came from. The 2009 credit crisis low was 6,400 in the Dow. The Dow has more than tripled. Now, we know that this rally, this largest, perhaps greatest rally of all time in the stock market, was not due to a great economic boom over the last 8 years. Still, the market moved. A lot of it, people would say, it was because of zero interest rate policies. Risk assets had nowhere else to go. Well, if everything gets a little bit better, maybe risk assets will have someplace else to go. Also, there was this boom in stock buybacks because they borrowing was so cheap, so that what they did. So if the economic policies of Donald Trump is good for the market, that may be another reason for the market to be strong, but you just can't ignore that the market, where it's come from, and it's come a long way. So to expect an exponential rise to continue without, first a serious correction may be a mistake. Plus the fact that obviously the market has cooled down because it rallied on expectations. It's going to, the policies that President-elect Trump has been talking about, the tax cuts and stimulus spending, will take a while. So as bullish as those ideas are, that the market has come that far, and to go further, it's probably going to need actual action of that to happen. Plus, most people would agree the biggest reason we've had a huge rally in the stock market since 2009 has not been because we've had a great economy. We've had a slow, sluggish recovery that has slowly been gaining steam and looks really strong right now, that the economy is ready to, grow more substantially at a more traditional 3 to 4% rate. But that means that we'll be moving off of the zero interest rate policy. We've had two tightenings since coming off of zero, so it's still extremely low. We will have more, but probably not a whole lot more, because they're still pointing in the opposite direction in Europe. So 2 to 4 quarter-point rate increases in 2017 is expected. That's not going to blow it up, but that is going to put pressure on it. So as some of these programs are positive for the market, you also have the headwinds of interest rates. So that'll be balancing things out. So while a lot of these programs may be positive for the market probably has a correction in the very near future, and the interest rates will no longer be pushing everything to equity. So it'll need another reason to rally. This has been Dan Collins, Editor-in-Chief of Modern Trader Magazine for Traders Exclusive.